If you are an investor who is looking for income, dividends are a great place to find that. And there are some really attractive dividends on the market today, yields over 5%. So I'm going to highlight 3 of the stocks that I really like right now. These are companies that are really well positioned strategically, long-term, to increase their cash flow and to keep paying investors that dividend yield. Because at the end of the day, if the yield isn't sustainable, then what are you buying as a dividend investor? My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The first company I'm going to go over is Verizon. This is a company I've covered a fair bit on asymmetric investing. Current dividend yield is 6.1%. The current price to earnings multiple, 16.4. Now, the challenge for Verizon has always been they have to spend a ton of money buying spectrum, building out their wireless network. But I think they've made some nice changes over the past few years. And strategically, they're now getting into more than just mobile phones and the connection you have for something like your smartphone. They're adding more broadband. They just announced the acquisition of a company to get into more fiber. And I think that means they're going to bundle wireless services for phones, broadband, whether that's fixed wireless broadband or fiber broadband, and streaming services. Don't be surprised if that's the next kind of triple play that we used to hear about from cable companies. That's something that Verizon is well positioned for. And if you look at their financials, they have done relatively well, and things should be improving over the next few years. In red, what you see here is cash from operations. So that's going to be basically how much are the operations and the previous capital expenditures that they made, how much cash is that spitting off? Right now, that number is between $35 and $40 billion on an annualized basis. This is all annual numbers. What has been variable over the last few years is the capital expenditures. That's what's in blue. And you can see the big spike in 2022, couple of things going on. That was when they were buying spectrum, and then they were building out their 5G network. So they're getting now payoff from that 5G network. That's why you see in orange, free cash flow really hits a low in 2022, about $14.1 billion. That is now up to $19.3 billion over the past year and should continue to rise. And it does need to rise because of this chart that you see here. The red line is what's called the payout ratio. Basically, that's the percentage of a company's net income that they're paying in dividends to investors. Over time, you can't pay over 100% in what you earn as a dividend. So you don't want that ratio to go over 100%, at least for a very long period of time. As Verizon has increased their dividend over time, and they basically just kind of steadily increased it over the last few years, haven't made big increases, but they also haven't cut it. That has actually eaten into that net income and free cash flow. They're basically paying out 100% of it as dividends right now. The challenge is the other columns that you see here. The debt continues to grow, about $152 billion worth of debt right now. That debt requires interest payments. As interest rates go up, there is variable debt on the balance sheet for Verizon. So some of that free cash flow gets eaten up by debt payments. Now, the good news is if interest rates start coming down, like a lot of economists expect later in 2024, both long-term rates and short-term rates, we should see those interest payments start to fall at Verizon. That could mean more money available to either pay down debt, which I think they should be doing, make acquisitions. Like I mentioned, they announced an acquisition earlier this month, or simply have a little extra cash that they could pay out as a dividend. But I think long-term, the strategic position where Verizon has one of the best 5G networks in the United States, they're leveraging that through not only smartphone connections, but also broadband and streaming. I think that will ultimately drive higher free cash flow. That's why I think that dividend yield of 6.1% is really attractive. And at the end of the day, this is going to be one of the last expenses that most people are going to cut if we do go into some sort of recession. So that's why I think Verizon is really well positioned. The next stock is UPS. Now, UPS has been under a ton of pressure from companies like Amazon, so a partner and a customer of theirs for a very long time, but Amazon has started delivering more and more of their own packages. So that has kind of taken some of the load off of UPS. Some of that revenue opportunity is now going to Amazon, being eaten up by Amazon. But I think over time, what we're going to see is more horizontal players in this business. So if you think about Shopify shops growing, Shopify shops aren't going to be building their own infrastructure and delivery services. They're going to be leaning on companies like UPS. So I think we're going to be doing more and more shipping through companies like UPS. And you can see here that they have positive free cash flow every year since 2018. And that dividend yield has continued to rise, now a little over 5%. They are paying out a little over 100% of their net income as a dividend. So that's something to keep an eye on. But that volatility of their free cash flow is definitely there as they invest in more of their delivery infrastructure. But I think at the end of the day, this is going to be infrastructure that we are going to need for all of the e-commerce that's happening, all of the delivery that's happening. Think about all of the last mile deliveries that are going to be happening from companies like Target and Walmart. They're leaning on some other delivery services right now, but some of those things are things that UPS can do more efficiently. Even autonomous driving is potential tailwind for them. So I think UPS is one of those essential services that we're going to be using for a very long time, a little bit like wireless services. And with a dividend yield over 5%, I think that's going to be a phenomenal payout to buy and hold long term. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The final stock on my list is Gaming and Leisure Properties. This is the company that owns casino real estate in their associated resorts and hotels in the United States. So if you look at Las Vegas, regional casinos, really all over the country, this is the company that owns a ton of the property. Now, this is a REIT. So their dividend is going to be a little bit different. They're going to pay out based on the cash flow that they're generating from the business. But you can see from this chart, the dividend yield 5.8%. And then I've just pulled some of the traditional financial metrics, free cash flow, a little over $1 billion per year. And then the interest expense, that's the other thing that I want to keep an eye on, is are they able to maintain a relatively low interest expense as interest rates rise? And they have been able to do that with long-term financing. But what I think you'll need to look at with this REIT in particular is their customers. Who's actually signed these leases and how are those businesses doing? If you look at the counterparties, the company has Bally's Corporation, Boyd Gaming, Caesars Entertainment, and then Penn National are going to be the main counterparties. Those companies are doing relatively well financially. I think Caesars overall is definitely doing the best because they have the most exposure to Las Vegas, but the regional gaming business has been relatively consistent even through the pandemic. So these companies are going to be able to continue paying their rent payment, and that's at the end of the day what's going to drive gaming and leisure properties business. The other thing is that inflation, as bad as it is for a lot of businesses, I think inflation could actually be a tailwind for some of these casino and resorts businesses. If you think about a hotel that was built 10, 15 years ago or acquired by gaming and leisure properties years ago has a fixed cost. That was the upfront cost that's associated with it. If inflation hits, and there's, let's say, inflation of 5% a year or 10% a year, that means the price of that hotel room or the price to actually go sit at a table game is going to go up at a commensurate rate. But your costs, your depreciation costs, are not going to go up at the same rate. If those debt rates are locked in, if customers are benefiting from inflation, meaning the resorts and casinos are benefiting from inflation, and it looks, if you look at all of the data from regional casinos and casinos in Las Vegas, it looks like that is certainly the case. People are spending more than they were in 2018, 2019. Then that should be a tailwind behind the business. And these are things that really compound on themselves because oftentimes if the gaming business grows, the rent that gaming and leisure property is getting does not grow at quite a commensurate rate, but that actually gives you more flexibility and more of a cushion for companies to pay that rent in the future. So I think all of these things are pointing in the right direction for this being a consistent dividend to own for the foreseeable future. So the stocks we talked about today, Verizon, UPS, and gaming and leisure properties, all of them trading for a dividend yield over 5%. I think that's a really attractive rate, especially with interest rates coming down. Those are pretty attractive yields. But let me know what you think about those stocks in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.